Now in this video presentation, I'm going to talk about the types of assets that are depreciated, how it will affect an income statement, and finally just show a few examples of the methods used. Now here in the blue right here, the light blue, this is an income statement, or a representation of an income statement, if you will. It starts with sales, and then generally we have 5 major cost sections generally. And generally this middle one here is your depreciation cost, which by the way is a non-cash cost. That means we don't actually pay anybody. It just lowers this number to this so that we can make this number lower, because this last cost here is our taxes. So the lower we make this, the fewer taxes that we pay. So the government likes to make sure that we depreciate properly. So you can see the higher amount of depreciation, the lower taxes. And we'll get to these amounts in just a moment. So some of the things that we have to depreciate, first of all, we depreciate long-term tangible assets. That's long-term tangible assets. So when I say the word depreciation, it's a plant or property or a car or something of that nature. We amortize, or amortization, for large or long-term intangible assets. And finally, we use depletion for natural resources. So there really are, we depreciate 3 different types of assets here. Natural resources, intangible long-term assets, and intangible long-term assets. So let's go down here and see how we determine the amount that we're going to depreciate here. Well, basically, generally when we use this one method down here I'm going to talk about, we take the initial purchase price minus the residual. For an example here, let's say I bought something for $55,000 and it has a residual value of $5,000. That's kind of what we're doing for the first thing. The second thing, we take the economic life of the asset. So let's say the life of this asset is 5 years, because generally 5 to 7 years is generally what we depreciate something out. Like a truck would be depreciated over 5 years. And then the third thing is we determine the type of method. Now straight line would just be, as it sounds, the same amount each time. So let's pull this down just a little bit. And I've got a couple examples down here for us. So you can take a look here that if I have purchased this $55,000 long-term asset, it has a residual value of $50,000 or $5,000, its depreciable cost is $50,000. So if we do straight line, it'd be $10,000 each year, and $10,000 over 5 years will bring it down to 0. Now that would be 20%, because I took the $10,000 divided by $50,000. So it's pretty straightforward. So each year that would be $10,000. So it would lower my taxable rate by $10,000. Now the second types of methods are usually called accelerated methods. That means we depreciate more early on than we do later on. One of them is called the double declining. Now the double declining actually starts with the initial cost. So this would be the initial cost. We don't use this initial purchase minus residual. This is just the initial. So let's say we purchase something for $50,000, and just to keep it simple, let's say the way we determine the percent is whatever it would have been straight line, we double it. So let's just say, for the sake of argument, that it was 20%, so I double it. So you can see 40% or $20,000 would be depreciated the first year, leaving a residual of $30,000, and then $40,000 the second year would be $12,000 would be depreciated off, and now it's down to $18,000. And we continue to do this 40% of each amount, $7,200, till we get to the last one. Now on the 5th year, it's kind of interesting, because the 5th year I cannot depreciate the full 40%. It only goes down to its residual value. So since it was $6,400, if I can't multiply by 40%, I can only take the $1,480 down for this. There's also the sum of the years digits, which we just take all the years up, add them up, and then divide the 5 by 15, and 33% is depreciated. Not used as often as double declining. Now, the tale of two books. If you watched the video on managerial versus financial accounting, we can use this as a reporting method, but these two we cannot. This is for more internal or managerial, because the government, the IRS, has mandated something called Modified Accelerated Cost Recovery Systems, or MACRS. Now you can use this for internal if you want, but when you report it externally, you must use these percentages. At least as of this year, 20% the first year, 32%, 19, 11, 11, and 5. And if you take a look, they actually depreciate a 5-year asset over 6 years. At least that's how MACRS works. So I hope this helps a little bit understanding how depreciation works.